Good afternoon, ladies and gentlemen. Thank you very much for joining this session on digitalization and new risks. Let me first introduce to you our honorable panel. So first we have Alexandra Maniati here, Senior Director, Innovation and Cybersecurity of the European Banking Federation. Then Dirk Houwig, Head of Conduct, Payments and Consumers of the European Banking Authority. And then Christopher Jackson, Head of the International Resolvability Division of the Bank of England. Also joining is Professor Dalvinder Singh. He's connected remotely. He's Professor of Law at the University of Warwick School of Law. Professor Singh was not able to join us physically today, but he has been available to join remotely, and we're very grateful for this. We asked initially Professor Singh to give some opening remarks here before we would start the discussion. But as he is not available physically, we agreed that I would address the opening remarks here on his behalf, and then he will step in afterwards. We're just looking at the... Is Professor Singh connected? Okay, so welcome Dalvinder, and again, thanks again for joining. I know your voice is not great today, but very grateful that still you were willing to join us here. So after the introductory remarks of Professor Singh, we will have a discussion in the panel, and then I would kindly invite you to ask questions and trying to make this a very interactive session and an interesting brainstorm. I think if you look at the topic, I'm absolutely sure that there are a lot of questions and interesting views that can be shared. So let me then start with the opening remarks of Professor Singh. When we think of shocks to the banking system and banks' ability to withstand and manage those shocks, we tend to focus on those risks internal to banks and their respective markets. However, we have recently experienced a period of external shocks forming a polycrisis state: the pandemic, climate physical events, conflicts, and an ever-growing number of cyber attacks. These shocks have the potential to pose a threat to financial stability. Equally, the March 23 banking turmoil reminded us that bank failures remain a real threat to financial stability. The positioning of cyber risk as an exogenous, external shock is perhaps more controversial in comparison to other external shocks. Cyber risk could either be seen as an exogenous shock, given the nature of some threats external to the financial system, or as an endogenous, so an internal shock due to weaknesses and threats internal to the financial system. The digitalization of finance is reducing our dependency on classic banking, and so requires us to rethink resolution of such banks in the information age. This includes risks such as misinformation and deepfakes that are either intent on stealing money or disrupting efforts to manage a crisis. Therefore, it requires us to look beyond the official safety net players when managing risks and taking a wider stakeholder approach to managing future crises. The complexity of the financial system and how it is linked to the real economy exposes it to a range of opportunities for cyber attacks. This is equally worsened by the fact that the financial system and real economy of a state are interconnected globally, leading to transnational opportunities for the identification of vulnerabilities and attacks. This makes the need for a coherent regional and international approach even more important. The sources of cyber attacks are, broadly speaking, state and non-state actors for political and also personal motivation. Cyber attacks take a variety of forms. Some are identifiable immediately, but others can stay in the cyber network for a considerable time before they are detected. All facets of the financial systems are exposed: institutional, payment systems, and exchanges. It's evident from the review of the cases that the level of disruption is significant. The Timeline Data Center, managed by Carnegie Endowment for International Peace, lists the location and type of institution of cyber attacks and the form of the attack. A review of the cases listed shows the scale and geographic reach of cyber attacks. It is evident that every economically significant country, developed or developing, has been affected by cyber attacks. The perpetrators have targeted a range of public and private corporations. Inter alia, access to sensitive data has been achieved. Moving now to a resolution angle. The importance of an orderly resolution is critical to ensure minimal disruption to the real economy. It has long been recognized that supervision, early intervention and resolution decision-making is expected to be aligned to better understand risks to banks and deciding when a bank is failing or likely to fail. The continuing efforts to improving the resolvability of banks by removing obstacles to resolvability is an important element of the process as well. Operational continuity in resolution has been an important component to assessing resolvability. Financial market infrastructure plays a critical role to ensure the orderly functioning of financial markets and are a prime target for cyber attacks. This is recognized by the ECB, and in view of this risk, the ECB has attempted to put measures in place to improve resilience to such attacks. In view of this risk, a new EU regulation was recently adopted to introduce a formal recovery and resolution regime for CCPs. In view of the transactions processed by CCPs, such as OTC derivatives and commodity derivatives, it makes them a prime target for cyber attacks. It is therefore evident that cybersecurity risk has been a long-standing issue for the European official safety net players that has informed supervision and resolution. Building on this narrative is the Digital Operational Resilience Act. DORA formally recognizes the extent to which the EU financial system is exposed to cyber attacks and the possibility of such attacks posing a systemic risk. DORA places responsibility on the EU official safety net players to coordinate efforts in order to respond and report such incidents to one another through the Joint Committee of the European supervisory authorities, the national competent authorities and the resolution authorities. It also formally envisages the European Union Agency for Cybersecurity being part of the joint efforts, with its mandate to improve technical cybersecurity. DORA formally brings into place the potential for new administrative penalties and remedial measures to ensure cyber risk is taken seriously by financial entities. The scope of the responsibility rightly brings together microprudential and microprudential competencies in a combined effort to ensure oversight to mitigate cyber risks. The expectation is that the requirements are for those financial entities that are particularly significant and interconnected in the EU financial system, which would include, of course, SSM significant banks. The instrument places responsibility on those financial entities to have in place an ICT risk management framework that includes response and recovery plans as part of their crisis management arrangement. In view of this, it's argued that DORA, from a sectoral perspective, formally recognizes the need for a coherent crisis management framework to mitigate such external shocks. It is expected that financial entities will need to undertake cyber stress tests to try and determine the risk level they are open to and to test their business continuity plans. The premise of a financial cross-sector exercise is a significant recognition of the importance of a coherent crisis management mandate that cuts across banking and non-banking activities. This mandate must bridge the financial system and the individual siloed approaches to regulation, supervision and resolution efforts that can be referred to as a EU official safety net. It will be important for the different parts of the safety net to address any potential confidentiality restrictions relating to disclosure of information between one and another. The unrelented moves to digitalisation of banking in an environment where news is almost instantly available via social media networks means that you can combine to create new forms of risks, the risk associated with misinformation and deepfakes. These issues need to be factored into supervision and resolution and inform crisis communication and management. It is a reminder of how media can play its role in bank failures. The importance of resolution is not to prevent bank failures, but to ensure when banks fail it is orderly as possible and with minimum disruption to the real economy. We have attempted to show how new risks can emerge and could disrupt or even cause banks to fail. We could argue that this needs us to relook at traditional crisis management frameworks from different angles by assessing the role of non-traditional actors to ensure that traditional official safety net players are crisis ready. So let me turn first to Professor Singh and see whether he has anything to add, or whether my summary, because I summarized his opening remarks, to be frank, it properly addresses what he wanted to share with us today.
Thank you so much, Jan, for the reading out of the opening remarks. I don't really need to add much more than what you've already said. The important issue really is to improve resilience within the system and improve institutional resilience. And so all I would really add more to it is just really the iteration of the importance of preparation and ensuring that all the safety net players understand the exposure to this type of risk. Sorry, I'm losing my voice as I'm talking, so I better cut out.
Well, thank you very much again, Professor Singh, and thank you also for joining us remotely and contributing. Let me then perhaps go to the panelists and start with you, Dirk, if I may. I think it's true to say that EBA sees cyber risks as one of the major risks that the banking sector is facing at the moment. And could you just explain what measures does EBA plan to take?
Check. Does it work? Yes. So thank you, and thank you for inviting me. I'm replacing our executive director today, who is unfortunately unable to come. So I think the key acronym to use in this context in the European Union is, of course, what Professor Singh already referred to, which is DORA, the Digital Operational Resilience Act, and I think it's probably known to everyone. The EBA has a very large number of mandates, as we refer to them, so technical standards, guidelines, and other measures to develop, which we started over a year ago and which will be concluding around 3 or 4 months from now, following a large number of public consultations and super helpful input that we've received from the industry. So we will put those into place, and then they will hopefully be adopted by the European Commission very soon, with the Council and Parliament having their usual scrutiny right. But then we will move into the more challenging phase of the oversight framework of critical third-party providers. And here we've taken already measures to actually map how the industry looks like. So we know there are around 15,000 of these entities in the European Union providing their services to banks and other financial institutions. We are now having to, of course, identify the critical ones that are under our direct supervision, direct oversight, sorry. And we are putting various measures in place, which I can come to later in a bit more detail, in order to make sure that this process works. For us, cyber risks are really, really important. Digitalisation it's an overused word to say transformation. There have been lots of transformations over the last years and decades, but this one is really different. Digitalization, it's very pervasive. It creates new interconnections and dependencies between actors in the financial system that didn't exist before. And it might be public joint ventures, outsourcing contracts, sub-outsourcing contracts. It really creates new risks that need to be addressed in different ways. And maybe later I'll explain a little bit what our ideas are, in what direction we could be moving.
Thank you very much. Perhaps indeed, before asking you an additional question, let me first turn to Alexandra, because I think it's extremely interesting to hear, the industry perspective on this interesting topic. So how do you see the state of play as it stands, and how do you see the right balance between basically embracing change, but also managing the risks that are naturally attached to them?
Well, it works, yes. Thanks, Jan. Thank you. Very happy to be here today and to be exploring the new landscape together with our supervisors and regulators. Digitalization offers huge opportunities for banks, because banks need to be where the customers need them. And customers do business online. They do private financial transactions online. And what they expect from banks is 24/7 banking, seamless, on their smartphone. And this is what the digital transformation of banks wants to serve. Now, at the same time, managing risks is also the essential business of banks. And no matter whether analog or digital, customer trust still continues to be the biggest asset that a bank can have. So when we're looking at digital finance, ensuring cybersecurity and resilience is the best thing that you can do for your customers. Banks, of course, have always been targeted, and for centuries it has been for the money. Now it's also for the data. And digitalization, Dirk mentioned it already, comes along with a new ecosystem that is constantly expanding, that is including new actors, namely tech companies, including big techs, fintechs, all kind of ICT providers to banks, but at the same time also providers of financial services, and very often the same ones providing both. So they form long supply and value chains. There is ample opportunity for new business for new actors, but also if you look at it from a cybersecurity perspective, it's a continuously growing attack surface. Now, because change and risk management has always been in the DNA of banks, we should also acknowledge that banks are among the most cyber mature sectors in the economy. And I was looking at the ENISA threat landscape for 2023. Indeed, if you look at the most targeted sectors, you see first public administration with 19%, followed by health with 8%, digital infrastructure and manufacturing 7%, and banking and finance and other services follow with 6% and less. However, because as Dirk mentioned, this new environment is full of interdependencies and connections, it's very obvious that banks cannot go at it alone anymore. It's not enough that they take only measures for cybersecurity and resilience. All actors in the supply and value chains need to play their role, from telcos to electronic communication providers, to big online platforms, to social media, to all the actors involved, and the governing framework indeed needs to be rethought in that way, and DORA is a very good step forward in that direction. So regulators, supervisors, legislators acknowledge the special position of financial services as a critical sector, and that's why in the last 5 years we have seen an amazing proliferation of cybersecurity legislation coming from all directions. And I think it's good to note here that if you're a bank, you have cybersecurity legislative requirements coming from 3 places. One source is the legislation that has to do with cybersecurity in the sector, and an example is, of course, DORA. The second source is legislation that has to do with digital finance in general, and there you will find security requirements as well, like, for example, the Payment Services Directive, which is now being reviewed. And the third source is legislation on digital in general, horizontal legislation, like the GDPR. That means if you're a bank and you are already heavily regulated, that when horizontal requirements come on top, very often you have already some stuff there or some similar requirements or the same requirements. So duplications and overlaps are very often the case. And there's a quite pronounced need for harmonization and streamlining and coherence, as you already mentioned in that respect. As a final thought for this beginning of our conversation, I would say that it is very critical for public and private sectors to work together on this and to continue working closely together. First of all, because we are all equally targeted. Second, because indeed we are dealing with new risks, new concepts, sometimes unprecedented. So we need to develop a common understanding and we need to do it together, also to capture the big picture. And on a third point, because there is a scarcity of digital skill and talent, and that is a problem both for the public and the private sector. Thank you. Looking forward to elaborating.
It's not difficult to ask a couple of additional questions, but let's. I was just wondering before I go to Christopher, perhaps to go back to Dirk, because you were mentioning this kind of risk of overlaps, etc., in the way things are regulated, and this touches upon a question that I had, and it might chip in nicely now. Is, as digitalization is moving so fast, how do we kind of, make sure that indeed, avoiding overlaps, but also kind of, having the kind of regulation that is kind of sufficiently flexible, basically, to encompass this kind of fast-moving target that you try to regulate. I was looking at Dirk. What do you see is the way forward? Is it the principle-based approach, where you try to avoid basically to regulate things that keep on developing and are difficult to capture in the way you basically position yourself as a supervisor? Do you have any views on this?
Well, I wouldn't call it principle-based regulation. The EBA, since it was created in 2011 after the financial crisis, has had and has until the present day a mandate to monitor financial innovation. And the way we do this is when we see an innovation, the first thing we do is we assess the potential opportunities, the benefits that could arise from the innovation for various parts of society, consumers, firms, maybe for the financial system. And then we assess the risks, again, to the financial system, to consumers, to financial institutions, both incumbents and potential market entrants. And then we try to come to the right balance between these competing viewpoints in order to come up with a view on what risks actually need to be mitigated. And then we see whether we have actually the legal power to mitigate it ourselves as a supervisory authority. We are not lawmakers. We are not elected, so we can't write law, and rightly so. So either we find a way to mitigate the risks through existing regulation, and if that's not possible, we write a legal instrument that, as we call it, that some of you may have heard of, opinions, which is a very innocent word. Of course, everyone has opinions, but actually it means opinions that are addressed to the EU institutions, to the Commission, Council, and Parliament, where we say what may need to be changed in legislation going forward. But that's a mid-term approach. That's about 2, 3, 4, 5 years. And everyone here is familiar with the time it takes for EU law to come into being. And that's what we did 9 years ago on virtual currencies, as it was called at the time, where we did such an assessment, and we recommended to the legislators in 2014 what should be done about virtual currencies. We don't fast forward, but we move forward to 2024, 9 years later. We have MiCA, so a legal text that now regulates some aspects of crypto assets, a wider concept than just virtual currencies. And the same we did for lots of other innovations. And we keep on doing this. We are now just looking at, once DORA and MiCA is in place, our legal instruments have been developed, and then we look into oversight and supervision of the actors. We're looking at new innovations that we see in the market, and we do the same sort of assessment again. What are the opportunities? What are the risks? Where should the right balance lie? And the balance sometimes lies differently, sometimes here, sometimes there, or sometimes there, depending on what innovation we look at. And this has worked well. Not often can we actually directly intervene because the activities are outside of our regulatory scope. We don't have a legal mandate, but very often the legislators listen to us and then bring into being legislation. Of course, that takes a while. Other innovations we can directly address, and we take views and we tell the industry what needs to be done, and via national authorities, because we are not a direct supervisor.
Thanks, Dirk. This is very, very clear. Let's then move to Chris, because I think one of the challenges for me as a moderator today is, of course, to bring the resolution perspective basically into the discussion, because I think we can talk about digitalization and cyber risk and other risks for long, but how do we see it from a resolution resolvability perspective, building also a bit on the introductory remarks of Professor Singh. So, what do you see, Chris, the implications of digital innovation for resolution authorities? Thank you.
I mean, I think in a way they're not new, but they've sort of accelerated, if you like. I remember back in 2014 doing a piece of work on preponderance of which bank channel customers were using, and already in 2014 mobile was the predominant channel. That's a decade ago, so over that period of time, level of friction for customer interaction just fallen continuously, and that low friction means greater speed, and I think that's one of the things at the heart of digital innovation. And we talked about vulnerability as well. I think there are also contagion channels and vulnerability channels there, but for a resolution authority and for a resolution planning, the first thing you need to think about, it can happen a lot quicker than you thought it might be able to unfold. you're likely to have less of a gap between you knowing something and everyone knowing something. You know, in the past, as resolution authorities, we enjoyed this little window where we had knowledge the market didn't have, and we had time to consider and act within that window. What digital innovation in banking and lower friction for customers plus social media has done is it's compressed that window, and it's made the ability to control the narrative more difficult. You know, in traditional media space, 2010, say, was first bumping into contingency planning for banks like this, or in the last financial crisis, the traditional media channels were predominant, and you had some degree of control. You had an interaction with media. Now media's extremely diffused. You don't really have much control over social media, and actually almost impossible for a resolution authority to respond directly in social media space. And likewise, a firm, I think it's very difficult to do that. So essentially what that's done is it's shortened the chain for everything. You have less time to think, less time to act, and less control. And for a resolution authority, I think that means you need to be more agile. You know, you've got to be able to respond quickly. And we were quite lucky in the run-up to events last year, and that a few years before we'd had a WhatsApp-related incident with one of the firms in our patch, and the firm was actually at that point of time didn't have a problem, but it was an almost purely social media-generated event, and that led to outflows, and it led to a very, very fast onset of crisis there. It didn't unfold to a failure, and as a result, we started thinking about fast failure and all the possible causes of accelerated failure, and we built a contingency planning team. And the first rule of going faster and being more agile is you need to know how to go slowly. What's the sequence? What are the steps? Can you drill people? Can you train them and exercise them? And it was really about that, being ready at a level where you could onboard and move people really fast to respond to an emerging crisis. So we built the infrastructure. We did some testing and exercising around that. And we were thoughtful about the scenarios we tested as well, and we sort of warmed people up a little bit to the idea that things could unfold really quick. In the end, by the time we got to the Silicon Valley weekend, it all unfolded a bit faster than we even thought, because it was Friday morning, and outflows started when we became aware of it, and then by the end of the weekend, the bank was sold. Now, traditionally, we would always have thought that a sale process for a bank would take, at least a week or two from the first moment we knew about it, but we didn't have that breathing space. We were sort of lucky with that institution, but I think the other side of it is digital innovation in the official sector, and among firms made some of this easier, quickly establishing data rooms, quickly being able to mobilize people, being able to do that in a diffuse way across an organization, enabled us to match some of that speed. And I think the other reflection beyond just speed and then the need to think about social media and have monitoring of that, and that'd be a very important feature of your risk identification framework, is probably, thinking about the communications in those kind of situations and thinking about the complicators, even if you get to a traditional resolution. The point about cyber and its greater preponderance and the bigger attack surface, well, it's also not independent in that a firm in distress, a firm going through resolution is likely to be something that threat actors look at and ponder, and there might be a higher risk of somebody showing up just after you've done your normal resolution and creating you a problem. So the need to be agile and ready to respond to that is certainly there. And I think with that, well, I don't want to ramble on too much longer, but I think with that, you're also in a place of needing to think very carefully about how you do nuanced comms, because you can't tell people, normally in resolution we want to tell people it's all okay, don't worry, we've got this, problem solved. The resolution toolkit can't deliver that for you against a sort of comprehensive cyber attack on a bank that's taken it out of operation. If the lights are off, you're not going to turn them back on with a financial restructuring. So, and likewise, if there's ongoing but managed operational failure or cyber risk materialized in that firm, you probably can't tell customers they'll have continuity on day one and everything. You're probably going to have to explain to them with a slightly bumpy ride, and it's a more nuanced message around that. because the last thing you want to do as a resolution authority or as a public body is tell people it's all okay, and then 2 minutes later that's disproved by an objective fact in the world. They can't get their cash from a cash plant or something. Your credibility's gone at that point. So I think it makes you alert to all of those kind of risks when you're thinking about this kind of stuff, and it's relevant for both firms and authorities. And I think, as Dirk alluded to, the kind of institutional landscape on the official side of people who need to be involved here can broaden out a little bit, and that's the sort of thing we need to think about as well on our side of the fence.
And maybe just as a follow-up question from my side, because you said rightly so, and it was also discussed this morning, you cannot control social media, but how do you see it in terms, because it's clear that, there are challenges in terms of how to communicate as authorities, to have coordinated communication and to communicate at the right moment in time, basically. Can you say a little bit more how you look at this and how you're preparing for this?
Yeah, I mean, I think the contents of the communication is sort of, of course, as I said, there's a little bit of variation to that depending on what scenario you're dealing with. I think communication is pretty layered here as well. So, as it always has been, so for customers, being really clear with them, very simple, clear headline messages everywhere, and across the authorities. And I think the point is, the greater the uncertainty, the more you have to communicate and deal with that risk, and that requires alignment across government. And for an international bank, it really does require close alignment cross-border, I think. All the things we were doing, all of those, and do them again, and better and quicker on that side. And perhaps there might be more agencies involved in at least informing that decision where you've got an operational failure. And because the time is compressed, I think that just, to me, says more of that stuff needs to happen before you bump into a crisis. You need to be more practiced, emphasize more on exercising, emphasize more on readiness and testing scenarios, so that when it does show up, those lines of communication are there, the frictions aren't present, and you've ironed some of that stuff out.
Thanks. Perhaps, Professor Singh, if I may, I won't ask you too many questions, but still wanted to take the opportunity, to involve you in the discussion, as you have so much expertise. In the introduction, you were referring to this polycrisis concept, basically, where you see the crisis elements coming from different sources. Could you elaborate a little bit further on this? As I think, for me at least, it was a new concept. I'm dealing with crisis for some years, but this polycrisis idea, where different kind of factors are starting to play a role. Could you say a little bit more about this and how different risks could start to interact, basically, and enforce each other?
Yes, certainly. Well, the idea of polycrisis was coined by the certain French sociologist Edward Morin. And the idea essentially is how crises can combine, but equally. So, for example, in the context of COVID, we saw the pandemic spread, but also we saw how it led to significant amounts of fiscal support to the real economy in order to ensure that it could continue. We've seen climate change with physical events leading to potential risks to not only to sovereigns, but my research has tended to look at the role of insurance in these situations. And what I've been looking at is how risks associated with different crises can be managed not necessarily by the state, but through private means. And one of the examples that in the cyber context is the need to address the insurance gap in the cyber market, so that there is a different form of financing when losses occur. So, for example, it is the case that we do need greater focus on financing of these types of risks. And it's important that we look at different types of market means to do that. So, for example, some institutions have issued cyber bonds. So these types of techniques are essentially potential mitigation techniques against the losses that may arise from many of the events that can occur when a cyber event materializes. So my argument is that when it comes to these types of cyber events, is one, do we have a clearer understanding of what each cyber event can, how each cyber event can impact the banks, but also how you then increase the pricing, the financing of these types of events from the insurance sector. So my view is that through the polycrisis scenario, where we have different combinations of crises, we've seen, for example, in conflict, both in the pandemic, in climate events as well, an increasing increasing use of digitalisation. And we've seen that increase in digitalisation is also exposed to cyber events. So, for example, during catastrophic events, earthquakes, we've seen cyber attacks occur to try and disrupt the authorities, try and disrupt society. And state actors are essentially trying to, when they're essentially trying to disrupt, but they're also trying to misinform as well to create chaos within society. And the challenge, in my view, is that when it comes to state events or state-led cyber attacks, these types of attacks are not insurable either, because they can be classified as acts of war. So in some respects, when it comes to cyber and banking, banking is in many ways the first casualty of these types of events. But they are not necessarily able to protect themselves. So I think that there needs to be a combination of public and private initiatives when it comes to supporting insurance to finance the potential losses within this industry. Equally, the industry would also benefit from insurance financing because it actually acts as a mechanism to ensure better due diligence when it comes to cyber compliance. So in some respects, we need to try and look at more innovative ways to try and reduce the pricing of insurance for cyber events.
Thank you very much. I think this is extremely interesting, no? Especially how you describe the interaction of risks and showing how complex the world is already, and it's not getting less in the near future. I would like to turn back to you, Alexandra, because you know, from and it's a completely different thing, but still very much related to risks. You were touching upon an interesting thing, a very concerning one, which is this war on talents. So if you think about digitalization, protection against emerging risks, you know, a lot of different players are fishing in the same pool. How do you see this going forward? Because this could, I think, be a challenge for all of us, you know, in mitigating these risks.
Indeed, Jan, it is a challenge, and because well, there are no immediate solutions, but in any way we need large-scale efforts towards not only educating the workforce of the future, but actually retraining and creating the workforce of today, both to leverage digital opportunities, but also to counter cyber risks. That's one brilliant area for public-private partnership. So we need to combine efforts, and we need to work together in understanding the different challenges. If I look at what SRB is doing at the moment, trying to explore the new risk landscape, if I look at the ESA's mandate, Dirk, you mentioned already how many policy mandates you have and what a big work you have ahead of you, also with the newly introduced oversight of critical third parties. If I look at what the Commission is doing currently with the implementation of the Digital Markets Act and how they need to look into new ways, into new aspects of digitalization and the role of big tech companies that act as gatekeepers. In that respect, you really need, besides having good legislation and regulation, you need the people to implement it and enforce it and to be able to understand the market. The issues are very often highly technical, so these are complex discussions, and the need for education is present.
Thank you. Just an additional question before we open the floor for questions coming from our audience. You know, I read recently, you know, there is this idea about digitalization that, you know, the benefits short term are kind of overestimated, but the benefits long term are often underestimated, and also this kind of fear of missing out, you know, so this kind of the tendency of markets to start investing rapidly to try not to miss something, and at the same time difficulties to kind of, you know, to really already understand how the world will look like in 3 to 5 or even 10 years. I was wondering, how do you see that from a bank's perspective, also knowing that, yeah, you also need your business going, no? So your infrastructure is also there to simply serve your clients, etc. So how do you bring things together, you know, to kind of make investment decisions, keep your business open, not missing out, but at the same time not moving too fast? Could you tell us a little bit about the challenges that banks face in this respect?
It's a difficult balance between innovating and keeping things secure and keeping all the compliance requirements in place. It's a difficult balance. Sometimes it is said that banks are too slow to innovate. Well, I don't think they are too slow to innovate because they can't. It's because they need to play by specific rules, and they always need to keep their business safe. Sometimes this does not apply to other actors in the ecosystem who sometimes say that they can innovate and be in the make and break business. Well, banks cannot be. Banks need to move cautiously. In my view, they have been transforming a lot in the past years, and I guess that's what we were discussing here also before. I do believe that what you see in payments, we have payment solutions in Europe that provide numerous tools for all kinds of needs. What you see in services, in banking applications and on smartphones, what you see also in the way that processes are being streamlined are all examples of how digitalization is leveraged within banks. That's also why it is important that regulation enables the deployment of this kind of efforts, because, for example, deploying the cloud for banks is an essential part of being able to go quickly to market, to have computing power on demand when you need it, But then if you look at the regulatory framework around cloud uptake, it's still quite fragmented across Europe. So if a bank is active in more than one European countries, it may have to go through multiple times through the same processes in order to be able to make the move. So this is something that could really help, the streamlining that we said before.
Thanks a lot. Let's open the floor. Looking at the audience, now that you're touching upon cloud-based services, I'm sure that this triggers a lot of questions from our audience. So who would like to start? You have a microphone? Oh, that's great. Could you please introduce yourself and say who would you like to answer the question? You can also ask several panelists to answer the questions, by the way.
Yeah, thanks, Maart Constant, Rabobank. I have a question for Christopher. I think in the discussion that just took place, I think there was an implicit distinction made between cyber risk being the causal factor of a crisis or an aggravating factor, right? And of course there are various developments trying to mitigate the risks, DORA, etc. But if those risks materialize regardless, and you need to deal with the crisis, then of course the question is, what is the solution? And I think you hinted a bit on that in terms of you may need to adjust your communication in terms of crisis management, dealing with the situation. But I think you also said it's a crisis that doesn't per se, to address the core issue, require financial restructuring or financial solutions. Do you think that the current framework for you as an authority, when such a crisis actually occurs and the cyber incident is the causal factor, do you feel as an authority that you at this point have the right tool set to deal with such a situation at this point, or do you think further changes to the resolution crisis management framework is necessary?
It's an excellent question, and I suppose the answer is it's somewhat modulated, in that you've got that level of severity problem with cyber and operational attacks and what you can cope with, and there's the stuff which is attritional, is happening in the background all the time, never gets to recovery or resolution, just managed by the institutions, and that's the preponderance of it, huge amount of that happening. And you've got some stuff that gets a bit further that's actually dangerous to institutions, that's starting to have prudential effects. You're getting pretty severe at that point though, because if you look at some of the operational outages that have happened, some banks have managed without payments for days, even weeks, without getting to that point. And I'm thinking, Ulster in Ireland at one point, and TSB, obviously there was an operational outage there on a migration. And they're very significant impacts for customers, but didn't lead to failure. So you get into this nook of then, okay, it's more severe than that. And if that's the trigger, there's a point at which, you're relying on the institutions to do the right thing and be able to recover themselves. Actually, I don't think it's very easy for an external party to come and go, I'm going to fix you, because of course they don't know the systems, they don't know the architecture, they don't know the infrastructure. So it's always going to be the institution that has to fix an operational fail like that. But you get into quite a wrinkly world. I think what I'm alluding to is there's several tricky problems here that exist within the existing framework. There's a sort of when are you done question, when's resolution relevant to this puzzle? And that's about that question about when's the market lost confidence in this firm, and that even if they operationally recover, they're going to suffer outflows and it's going to be pretty bad, or that the disruption's so severe and it's amplified on social media that you don't think they can survive on the other side of it once they reopen, and it's going to require some state action to reassure. So there's the sort of a when do you get into resolution in the existing framework question, which is tricky, perimeter question. And then there's a sort of, as long as the firm can recover itself and get the lights back on, if it's a bit bumpy, then financial restructuring, liquidity backstop, clear communication, they may all help, and might be enough. You've got a kind of bookend though, which is if you generally have a completely paralysed firm, it's locked out. The lights aren't coming back on anytime soon. Yeah, the resolution framework, that doesn't contemplate that as a scenario. We conspicuously don't have a fix for that situation. I think that's at the edge of the policy framework, and that's a question for policymakers of how tolerant are you about those risks? What do you want to do about that? Obviously, the US has done some work on that with sort of safe harbor and other stuff. and others are doubtless working through that stuff. So there's certainly a bookend which you get to, and it's useful as a resolution authority to get there and go, gosh, that's the place for our decision-making framework. We can make decisions, but they might not have real-world effects, and all the policymakers and all the decision-makers in the puzzle need to understand that's the perimeter edge of where we can go and no further. And so whether it's fixed in the resolution regime, which might not be the right place to fix it actually, or whether it's fixed elsewhere in regulation on resilience across government, and then there might be some state coordination on how much resilience you want in the system. So there are some modest-sized questions in there. And I know I've rambled a bit. Hopefully that answered your question in a way.
Thanks, Chris. We would like also to ask Dirk, any views from your side on this? I think I'm in this easy position where I can simply ask or repeat the questions. So do you think the framework is fit for purpose?
Well, I think there's a parallel question. I'm not quite sure whether you're referring or whether the audience member was referring to that. Do we have the right toolkit? Right toolkit for resolution, we've just heard from Christopher. For us, it's also a question, but do we have the right toolkit, the right approach about innovation, the regulation of innovation, so and dealing with risks from innovation. So there's this traditional concept of the 3 C's to contain a risk, to complement, and to coordinate. And we're not quite sure really whether that is really an appropriate way to deal with innovation. So if you look at containing risks, yes, of course you can contain it. If there's a risk arising from an innovation, you can regulate it down, you can supervise it down. The immediate effect is very efficient, but you're actually killing the innovation. So we're not sure anymore whether that's the right approach to use for innovation monitoring, regulating innovation. The other one is about coordination. Yes, coordination between supervisory authority is right, but let's look at resolution for a year ago with Credit Suisse and SVB in the US. And as Christopher said earlier, the speed with which you have to coordinate the activities of various national authorities, maybe across borders, is immense, and everything is ex post. So does that really work? Not so sure. This 3rd C about complementing, so if there are certain pieces of law in place and then we come in and we just plug the gaps, doesn't work anymore. So at the moment we are looking at more the 3 A's, if I may refer to them. So on the one hand, to accompany innovation. So this is what national authorities already do, what we are doing, what we have started doing several years ago. At the moment an innovation emerges, we accompany the innovation. We have a network of what we call European Forum for Innovation Facilitators. Not very nice way or handy way to describe it, but these are the national authorities that have sandboxes in place, that have innovation hubs in place in their jurisdiction, and we bring them together and they monitor these innovations before they are regulated in a kind of a sandbox setting. So we actually are aware of the benefits, we can understand the benefits, we can understand the risks, and that's much more proactive. We also adjust our supervisory framework, that's the 2nd A. So we need to monitor much more quickly, much more frequently. And that's what we are doing with our national authorities as well. Of course, it's resource intensive, and national authorities and the EBA or the other 2 ESAs, we don't have unlimited resources, unfortunately. But that's what we need to do. And the 3rd A is to anticipate. And here again, we need to look into what's coming, what's on the horizon. Many years ago in the prudential space, we introduced stress tests for banks. It's now commonplace to do every year. The ECB does it, the EBA does it with its populations of firms. At the time, it was revolutionary. Lots of issues were raised about, is this practical, what's the cost benefit, and so on. But it has had an effect. We need to do something similar in the area of cyber risks as well. The ECB, the SSM started, I think it was last month, for the first time to do a kind of a cyber risk stress test with 109 of the largest banks that they have. We need to do something similar on a wider scale, to do a stress test of the cyber resilience of banks and other financial institutions. And the DORA framework, the legislative framework, imposes on us the requirement to set this up on a regular basis in the EU as well. So that's one of the things we'll be working on. So our approach is going to be changing, and our mindset is going to be changing, and our toolkit is going to be changing as well. focusing on digitalization and the risks that they arise, including on the resolvability of banks eventually.
Thanks a lot. Another question over there.
Thank you very much, and thank you very much for the roundtable here. Eric Luthier of Mazar, just to build on the point of cyber here, because I think it's a very important one that we mentioned many times today. You mentioned that the EBA might be working on a broader stress test for cyber as well, inspired by the ECB. We learned today there's a lot of collaboration, at least I learned, with the SRB and the ECB on the current stress test. My question will be regarding the link with the other activities we do with the UK and the US as well. I know there's been stress tests done in the UK, for example, on cyber. So are we also collaborating at that level there with the other authorities for the learnings there?
Thanks. Who would you like to answer? Chris, could you take that up?
I mean, I can start. I think there's a number of forums that are pretty interested in this. Obviously, the G7 are interested in coordination on cyber, so at that level, there's work ongoing. In the UK, banking and EU authorities in the US have a pretty collaborative engagement on resolution. It's close. We conduct exercises together. We walk through stuff. We look at how things might unfold. We test and pressure test the pipework for coordination reasonably frequently, at senior staff and principal level. Have we fully addressed, cyber and operational risk in that? It's a work in progress. There's been some work done in the past, a few years ago actually, and then, it's one of the topics we're interested in at the moment. And I think like all stuff on coordination, in a way, one of the lessons from the last year with SVB and other stuff is, well, that was a bank we never planned for a coordinated resolution of, and yet all the pipe work was immensely useful. And around the edges of Credit Suisse, well, that was a bank where not all three parties were in those sort of exercising sets, and yet the infrastructure was really, really useful because we could talk to the US live about stuff we could coordinate. There was an existing framework for doing that. There's a clarity on how we communicate stuff and how the home and the host work together. So a lot of the existing stuff really does help here. But I think to the point others have made, and I was trying to make earlier, it can be quicker, it can be a bit more muddy, and there are other acts in the puzzle. So I think there is probably more work to do here. But the stuff that is being done certainly isn't without utility, and at least that kind of cross-authority coordination works pretty well. UK, US banking union.
Thanks. Any other questions?
Yep. Good afternoon. Thank you for your perspectives. My name is Wendy Schonger, the Volksbank. My question actually is quite practical. So I'm in the Recovery and Resolution Planning department of our bank, and we've been spreading the word on resolution and what it is. So within the bank, people know why they are doing what we're asking them to do, or basically what also you're asking them to do. So on the critical functions, we deliver data, and we explain what critical functions are. And then we have critical contracts. And then comes outsourcing with criticality, but a different kind of criticality. And then comes DORA with criticality, but again, a different kind of criticality. So I have a call and I have a question. My first call to you, I don't think you all, but I think some of you, is to stop labeling things critical. Find another term. Urgent, important, whatever is, but please stop with critical. And then secondly, so we've been trying to map, and the mapping doesn't work out. So my question to you is, do you have any suggestions?
Again, I'm in a comfortable position as moderator today, so. But I do think that you have a point about critical functions. I never used that word so much before I joined the SRB, and since then it's crossing my desk almost every day. So, but I'm looking at you, Alexandra, from a business perspective. Can you say something about this? How you see the struggle, or
well,
should I? No.
That is not fair, but I
But
will
I'm here
take
to
the
be
opportunity.
unfair. I'm here to be unfair.
I will
so.
take the opportunity to support what you're saying with another example on incident reporting. Because if you're a bank, and depending on what type of bank you are and what type of incident you get, you may have to report 6 times to 6 different authorities with different templates, different timelines, and different typologies. And Dora is already making a good step in that respect, trying to streamline at least 2 of those requirements. But indeed, this is what we were talking about before when I was mentioning need for harmonization and streamlining. It's coherence in typologies, in language, in templates, in a lot of technical aspects of the requirements.
I see that Dirk is already warming up, but I think my Dutch friends of the Volksbank cannot complain, you know, that I'm even asking Alexandra to reinforce the message before it goes to EBA. No? So.
Well, I mean, the terminology critical has not been invented by the EBA or introduced by the EBA, but by the legislators. So I'm of course not here to defend the EU legislators, but I can absolutely understand where you're coming from. I think the reason why the word critical is used is because as legislators, I'm speaking not for them, but also as regulators and supervisory authorities that we need to acknowledge that not everything requires our intervention. We don't want to meddle in every single thing that you do at a national level as a bank. So we have come up with a term, we define terms like critical to separate those that we think are relevant in the EU's perspective, in a cross-border perspective, and those that are not. And therefore, we come up with these terms. I can understand why that is tiring. It will probably be the most innocent word to describe it for you. But I mean, Alexandra, you just mentioned incident reporting under the PSD2. Yes, there are various templates that you have to complete. I'm not quite sure whether 6 is correct, but we can have a chat afterwards, so I can test you on that. But the DORA framework, the DORA framework definitely harmonizes and standardizes this across the financial service sector, and is heavily based on incident reporting under the Payment Service Directive, to which you referred earlier, because that's been in operation now for 3.5 years, incident reporting. All 4,500 banks have to report operational and security incidents, and around 1,500 payment institutions, electronic money institutions, so a population of 6,000 financial institutions. And they've been doing this for the last 3.5 years, as I said, and it's quite some work for you to do this, but it's really, really insightful for us. So we have just last year assessed around 6,000 or 7,000 of these incidents that have been reported to us via your national authorities to which you report. They have then reported it to us, and we've been able to analyze the things that's been reported to us. We were a bit surprised about the large percentage of actually operational incidents. So 95% of the incidents that occur in the European Union amongst yourselves are of an operational kind, usually process failures, systems failures. And only 5% are actually security incidents, and a subset of those are cyber related. But what's also interesting is that around 40% of those incidents have a cross-border dimension. And this is again then something that's of interest to us, because there is no national authority that automatically says, okay, there's an incident that involves other countries, there is a bank that has operations in other jurisdictions, therefore let's make sure that this is very quickly conveyed across borders. No, it doesn't happen necessarily automatically. So we need to be aware of this, and that's the reason again why we introduce terms like criticality, in order to be able to separate out those things that operate across borders, and then we have a contagion effect across borders that we want to prevent. So under DORA, this will become a bit more streamlined. Our own requirements for incident reporting, we already streamlined 2 years ago. So we assessed the reports that were coming in. We realized lots of things that were reported to us we don't need. Others we actually missing. So we amended our requirements 1.5 years ago in order to reduce the reporting burden by 20% for you, roughly, we estimate. So we learn our lessons, and we are getting better. Whether we can find another word, a better word than critical, I will go away from this event and I think about that. But thank you for the feedback. Yeah, I can understand that.
Thank you very much. Further questions around innovation, and so now we get started. Yes, please.
Complete the Dutch banks corner, Juana Mila, ABN AMRO. You mentioned a bit earlier the cyber stress test, which is now taking place, conducted by EBA. What do you expect? ECB, sorry. Yeah. What do you expect to be the next steps after the cyber stress test? So what could be the lessons learned, and what could we do about cyber risk? And then towards Christopher, because the Bank of England has conducted such an exercise about a year and a half ago, if I recollect correctly. What were the lessons learned for the Bank of England, and what have you done about cyber risk after this exercise, just to share with us? Thank you.
Let's indeed move to Chris. I think it's really useful to hear the Bank of England perspective, no? Because as the ECB is not here, it's difficult to predict exactly what will be next. But for sure, Chris, you have some interesting insights.
Yeah, look, I mean, there's probably a limit to what I can say on that. But of course, there's been set up ongoing where the bank's been involved with not just the cyber test, but also penetration testing, looking at our firm's resilience over time. And then our internal thinking on exercising, I think it does draw out. The industry can provide some of the solutions, certainly some of the previous work that's been done, has helped develop industry standards for reconnection and these kind of things. And there's plenty of ongoing work there. I'm not sure I can add an awful lot of colour on the cyber stress test itself, to the extent there's lessons to share. I think there's stuff in FSR on that, but I think as an authority, just as a reminder, there are novel risks and they materialise in ways we don't anticipate, and that firms have an area where they still have work to do on readiness. I'm not adding an awful lot of colour there, but I think that to the extent there's stuff we could say is public.
Further questions as we're getting to the end of the session, but there's still time for a question. Yes, sure.
I'm afraid that the Dutch sector is dominating here, but Sebastian Bong, ABN AMRO Bank as well. I just had a question to both Dirk and Christopher regarding the digitalization of the sector. I mean, when a crisis unfolds with the current speed and people can just remove their deposits, the crisis can unfold much more quicker than they used to. How do you assess the adequacy of authorities to make the right decisions in a timely manner? I mean, all the reports that for resolution purposes are currently provided are by nature backwards looking, evaluation data sets, bill and data points, etc. Whereas in the next 2 hours or even 24 hours later, that data might be irrelevant.
Yeah, look, I think there's a general point that in a cyber incident, operational incident, you're going to have you may well have much less comfort over the information on the institution's position. It's going to be grayer and possibly imperfect. In a way, the information is always somewhat wrong when you receive it. It's always aged. It's always not precise, and you shouldn't treat it as such. You shouldn't treat it as being accurate and very, very precise. It's sort of broad brush most of the time. It's just even more so in a cyber or operational incident. And then I think when you're dealing with that, so making sure the decision makers understand they're making a decision in an environment where they have less certainty. And that goes back to the exercising point, running people through it, exercising, testing, preparing the decision makers for the fact that they may not have all the information may be imperfect, and thinking about how we respond to that and where we can anticipate where those risks might emerge. For example, valuation, how do we deal with that? And in many respects, going faster in a world where you're not prepared like that is about deciding which risks to accept. And there's a lot of risk acceptance in going quicker in general. And that's because if you ask for the capabilities for firms to fix that, you just end up with a sort of infinite treadmill of asking for ever greater capability, which is very, very costly and actually might not buy you much in that scenario anyway. So I think that's a long way of saying it's about practicing it, and it's about being ready, and it's about being prepared to accept risks in that scenario and try and manage those as best you can. And they're particularly information stuff. And some of that, there are probably things to manage that longer term, like sort of data warehousing, periodic work that firms could do. Those are all potentially interesting ways to alleviate some of that risk. But they won't eliminate it in a severe operational outage.
I think we're coming to a close.
Can I just add?
Yeah,
Sorry, half a sentence. Just want to challenge your assumption that digitalization has necessarily led to deposits being able to be withdrawn more quickly. That's quite an intuitive thing to say, and I thought so as well, but actually we looked into this a little bit, and it's not necessarily the case. We have 4,500 banks in the European Union, and actually every bank that I am a customer of has a different restrictions placed on the withdrawal of deposits or the transfer of deposits from accounts. There are limits of 1,000, 2,000, 3,000 euros per day. Some banks even require you to go to a branch before you can raise the limit. It depends on also what sort of customer you are. Are you a private banking customer or just a normal customer? Are you a local authority? Are you another firm? And so on. So the withdrawal of deposits having accelerated or is easier because of digitalization, not always the case. We have not looked at that systematically to come to an established view, but I wouldn't necessarily subscribe to your assumption that that is what's generally the case and happens in the EU.
Thank you very much. I think we're getting to an end, as I said, and normally, this is my opportunity then to summarize the discussion, and then I would give you kind of, a summary around kind of, the complexity of the world we're living in, and it's getting more complex, and now we need to be more transparent and communicate better, etc., etc. But instead of using the last minutes for this, looking again at the screen, having the pleasure of Dalvinder Singh with us, can I just ask you, Professor Singh, as a closing remark, what would you see looking ahead for the next 3 years? What would you see the biggest risk, but perhaps also the biggest opportunity? Just as a closing remark from your side, if I may. As I did your opening statements, perhaps now it's a fair deal, to ask you to close the session, I think.
Sure. Well, from the various sessions, I think it's important to be able to try and ensure trust within the system. And what I've been listening to is about the efforts to try and mitigate the risk of cyber attacks crystallizing. The issue, I think, overall going forward that needs to be better addressed is a recognition that external events such as cyber could potentially lead to banks failing and or likely to fail. And in view of that, the policy needs to recognize that there needs to be clear confidence of central banks to be able to step in and provide the types of assistance that they may require in order to minimize the impact of the disruption. So we recognize that cyber events can be systemic, one. We recognize that there is critical aspects that can be weak links, which aren't necessarily within the institution, but may be outsourced from the institution. And so we need to appreciate when it comes to critical services, for instance, that they may exist outside of the formal bank, but necessarily important for the provision of the services that the bank offers. And I think that misinformation, I guess, in many ways recognized the importance of social media. We've almost put our hands up in a way to say that we can't control social media. I would think that we need to think about how social media will, in the future, be needed to be controlled in a crisis, because if it is a situation of multiple bank failures, state actors that are willing to cause disruption or cause chaos will exploit that. And in my view, the official safety nets will need to try and work with social media platforms to ensure the reliability of information and the continuity of reliable information during the whole different stages of the crisis. So in my view, the important lessons going forward is that communication is critical, but also the safety of accurate information has to be safeguarded. And I think the official safety net needs to work harder with social media platforms to try and achieve that end. Equally, I would emphasize the need for risk mitigation through private means and the extent to which banks have access to additional forms of financing. Because otherwise, as we mentioned in terms of the prudential side, the losses will fall on the prudential side. And so that could lead to, a loss of trust within the institution as well. So I think that a combination of looking at how these risks materialize, but also a recognition that resilience and resolution are something that work hand in hand, and that cyber is something which needs to be within the forefront of that narrative.
Thanks a lot. Thanks a lot. So big thanks to our panelists, Alexandra, Chris, Dirk, and also you again, Davinder. Thank you very much for willing to join, and wishing you a speedy recovery. And thank you very much for attending this session. Thank you.
Thank you.